So now we're looking at the dollar index. This is that market maker buy model. This is the original consolidation. Okay, so just look at what we've done here. This is just a matter of looking at where you can see a clear consolidation, and it doesn't always look like a perfect box. Okay, what I usually look for is some key high. Okay, what makes this a key high? Well, it turned and traded a lot lower and broke a significant low. So in here, I'm going to frame out where a consolidation would be, and that's what I'm delineating here, and the return to the consolidation. So a market maker buy model is a consolidation, a break lower, return back to consolidation. That doesn't necessarily have to happen. Not all of them will have that. So through your time in this mentorship, you will see me refer to market maker buy models and sell models that do not have the return to the consolidation. Okay, it doesn't need to do that, but we expect it to. So it does so here, then it trades off again from distribution, which is that high, trades one more time up into distribution again, sells off into smart money reversal. Then the market will rally, come back down, provide a low risk buy, reaccumulate. It's picking up more buy orders that match up with the old areas of selling, and then it rallies up and runs out the original consolidation high where there's buy side liquidity. And then we have 30 pips stop run above, and we run just a little bit above that, but 30 pips is a good ballpark measurement, and also trading up into that mean threshold. Okay, so a lot of things converging here. Now this was where I said we're basically done. It can go up a little bit more, but this is the remaining portion of it, and then we get this slide lower after it goes into the mean threshold and sweeps 30 pips above the original consolidation. And measure moves are just simply this low to this high added to this low projected up. It's essentially that level here. The easiest way of saying it is this is a classic bull flag, where when your institutional order flow is bullish, then they will work. But many times you're going to see bull flags form just because they may fool you into thinking they're there when it's opposing the underlying institutional order flow. So it's important you understand that we're outlining the logic that gets behind why these markets move to where they go. Okay, so you were framed on how and what would constitute a smart money reversal down here with the logic of the rejection block, and we framed out all these reference points here and how they line up over here and targeting the buy side liquidity over here. If you just took a run to this initial run here and that was it, that's all you ever did, and didn't participate in any portion of this move here, is that a failure? No. Don't be tricked and lulled into thinking that you have to get this exit, because if you buy down here or here or there or there and you get out just at that high or just below it, it doesn't even need to break that. If that happens, you have a model that works. Moving into the 15-minute time frame, back up into here. Here's that breaker, these consecutive down close candles prior to these relative equal highs being taken out. It could have traded up to here, but I'm teaching you the logic that my mind goes to this first, because the relative equal highs, that is a PD array. While this is a short-term high that gets ran out, yes, I will admit that's true. But if we have relative equal highs prior to something like that forming, I'm going to look at the low prior to that. So if we break down through, this is the level that's going to be most important to me. And you can see the market trades up into this sell side imbalance, buy side inefficiency, or fair value gap. And it does so in New York and attacks the sell side liquidity there and reaches into it at London close at noontime. If you look at the daily range in this regard, it's the open, rallies up, creates the high of the day, continuation in New York, makes the low of the day in London close. So again, this framing is a scalper's daily range. So we're looking at midnight to noon New York time. Now, here is the market maker sell model, which is the opposite of what we saw in the dollar index with its buy model. This is a sell model. We have an original consolidation. It runs up out of the consolidation, comes back down into it. Okay, this does not have to happen, but if it happens, great. If it doesn't, it doesn't matter. But this is a reaccumulation. What is reaccumulation? So what's happening is smart money's buying down here, and then they're buying it in here, and then it drops back down and they buy more of it here. Then it runs up into the fair value gap on the daily chart. That's the smart money reversal. This is where smart money or the interbank traders are offloading their longs and shorting heavily. They get to this point, the algorithm stays up there. Notice what's going on? It's staying up in there. Is this buying and selling creating this perfect little area of consolidation? Like they're all working in concert to create this opportunity for the pause up here for smart money to assume short positions and offload their longs. Think about this, folks. Think. This is all design.